take a look at oil prices this morning, dipping just a tad, 72.03. Brent crude, 67.88. Do I have those numbers right off the top of my head? Yep, 72.03. Oh, I missed the WTI, 68.20. Nigeria's benchmark is 75. Natural gas is down. Still in oil and gas news, Iraq is planning to raise oil outputs to 6 million barrels per day by 2029. Iraq presently producing about 4 million barrels today. A whole lot more to get into on the oil and gas side, including the NNPC, plus a lot of stuff going on in the UK. Let's bring in the Chief Investment Officer of Cordros Asset Management, Arnold Dublin-Green, to talk about this more. Arnold, good morning to you. Good to see you, man.
Good to see you too, Rose.
How do you see the trajectory of oil prices with where things are now?
I think with oil prices, if you look at it year to date, it's sort of been range bounding. The weakness in oil probably came, or not probably, but actually came in at the end of February, when you had all the geopolitical tension. So regardless of any supply shocks or resilience in supply from the non-OPEC countries like Brazil and US, I think considering, or rather, should I say considering the supply shocks and also considering geopolitical tensions, I think oil has held up pretty much, pretty well, rather.
We're seeing forecasts of $70 from Wall Street for 2025. What do you make of that forecast?
Yeah, I mean, the forecast shows a bearish view on oil, which we all see softer structural oil prices, right? So you have OPEC plus members coming in, potentially boosting production, and then you also have a slower than expected demand coming in for the rest of the year. So I think just Wall Street and Cordros, we just have a softer oil approach, oil price for the rest of the year.
I want to bring things home. Nigeria looking at raising oil production to 2 million barrels per day by the end of the year. We've seen all this going on in river states and pumps being blown up and pipes and stuff like that. I mean, do you think we can still get there, 2 million by the end of the year?
So it's ambitious, right? And if you asked me a few weeks ago, I would have said yes. But what's happened recently has really questioned, I guess not questioned the ability to get to 2 million barrels, but the ability to sustain 2 million barrels.
Right.
I think something that most people aren't talking about is how easy this is showing us, how easy it is to
disrupt,
to topple, to disrupt not just oil but the economy, right? Because a huge dollar receipts from oil. What does this do to our forex? What does it do to everything else? So I think it's the worry is, okay, we might get there, but can we sustain? And that's the question for me for the rest of the year.
NNPCL, front page of today's This Day newspaper, Nigeria's newspaper of record. They've leveraged oil outputs for loans and stuff to the tune of about $21.5 billion over the last 6 years. What do you make of this development in terms of what the impact is?
So it's a double-edged sword, right? So on the one hand, you get liquidity now, which we need, right? You get dollar liquidity now. On the other hand, you're mortgaging your future, right? And that's the problem. And a few things now beg into question. First of all, one of my worries is the cost of borrowing. So we're borrowing at 6% SOFR, which we're questioning, plus country risk premium of 3 to 5%. You're looking at 9 to 12%. Debts, USD, Nigerian Eurobonds are cheaper than this, where you've actually got oil. So the question is, how was that contract negotiated on that side? And then you have an opaque structure with payments where the spread between strike and original price, strike and nominal price goes into an offshore account. That goes into question. And then the strike price with these things are normally below Nigeria's price, right? So there's so many questions to be answered. But you try to look at the positive and look at the other side of the sword where you have the liquidity now. But then you have to ask, how were these contracts being negotiated? So there's a lot of questions behind it that makes me worry. It makes me worry, especially on the cost of borrowing side. Is why is it so expensive? And we should be asking that.
Let's get to, you mentioned Eurobonds, but there's this sovereign bond auction later today, if it hasn't already taken place. Settlement on Wednesday or so. 300 billion is what we're looking for. Are sovereign bonds for Nigeria, are they attractive?
So there are two ways to look at Nigerian bonds and fixed income, right? So you have your hold-to-maturity investors. Those investors that don't mind holding the security until the end of the security, the life of the security. And then you have your mark-to-market investors. These are investors that come in and at some point they might not be able to hold to the life of this bond or the life of the security because they might need payments now. Saying that, Nigeria is attractive for both, right? Nigeria is attractive for both. If you look at what I like to call the triple threats, right? We're in a disinflationary environment where inflation is coming down aggressively. We have some FX stability. And then we are probably going into a dovish monetary policy environment, right? So you have those in play for the mark-to-market guys. So if you're marking to market, which means you might not be able to hold to the end of the security, then you want to buy a bond. You want to buy a long-term bond. You want to go into the bond auction, which is good because on the mark-to-market, it's a long. We call it long duration. So on a long duration, you get a better payout when you sell this bond. So it works, right? The environment works. But then also you look at the hold-to-maturity investors. I would go on the short end. I'll buy a treasury. Treasury auction came out at 19.94 discount rate, which is roughly 24.8, 25% on a 1 year. You're getting a real positive. When I say real rates, I'm looking at inflation minus the rate. So if I'm holding to maturity, I am buying a treasury. If I'm mark to market, I'm buying a bond.
Yeah, okay. And speaking of treasury bill auction, what they want to have on the
on
19th,
Wednesday? Yes.
I mean, what do you make? Money market security is also attractive.
Yes.
Yeah.
Same thing. I think I like money markets, right? So you're getting 24, 25% in a lower inflation environment. Again, stable-ish FX environment, as well as coming into a dovish environment. I think for the investor, it's good news. When the investor is good, it works.
Yes. Let's go to the UK. Rachel Reeves has her big spring statement on Wednesday, but there's been a whole lot of talk about cutting costs and trying to right the fiscal ship over in the UK. So if they're saying they're going to cut about 10,000 jobs in the civil service, they're looking to save about £2 billion or something to that effect. I guess, what do you make of the developments there?
So UK inflation election rather is on the 1st of May. So this seems to me as political window dressing than anything. I mean, we don't talk politics, but it's political window dressing. Real savings for me comes from structural reforms, and this is what the UK needs. So this right now, cutting headcounts look good. It shows fiscal discipline from their side. But this is nice and comfortable just a few days before election. So I think for me, the real question comes in at what sort of structural reforms can they put in place for the economy rather than window dressing.
Gotcha. So you talk, and maybe another time we'll talk the global outlook. I think you did talk about global investment last time you were on here with Bosun. But is the UK attractive, or because of the reforms, you want to take a wait and see approach?
So from my view, the UK will always be, it is a developed market, right? It's a developed economy, deeper capital pool than we have here on the continent, here in Nigeria. But the UK has struggled since Brexit. It's really struggled since Brexit. Brexit, you've seen capital flows go from UK to Germany, for example. The UK 10-year bond is yielding about 4.7%, and the German 10-year Bund is 2.7%, which shows country risk. So the investors feel safer in Germany than UK. So for me, until these structural reforms come into play, if I had to pick Europe, I'd look elsewhere than the UK. Until they, like I said, UK has struggled since Brexit. They had Brexit, then they had COVID. So a double whammy, in a sense. So I'd wait and see. It's a wait and see for me.
Arnold Dublin-Green, Chief Investment Officer at Cordros Asset Management. Always a pleasure having you on the show. Thank you so much for your time.